Welcome to Ekesha's Foreign Exchange Made Easy class. Today is 21st session. Last day I have discussed vanilla option payoff, that is for call, short call, long put and short put. Today I will discuss vertical spread, that is bull call spread, bear call spread, bull put spread and bear put spread. Before I begin the class, I just recapitulate the last class discussion. In the last class, I have discussed on the payoff of vanilla option, long call, short call, long put and short put. You see here the long call and short call is given. The strike price is 17,500 and premium is 210 and same is short call. Here the buyer will lose the premium up to the point of the strike price, that is 17,500 for buyer of the call option, and if the spot price decrease from the strike price, he lose the premium paid, that is 210. And if the spot price crosses this strike price, then the loss will be gradually reduced up to the point of BEP, where the loss will be nil. And if it exceed this point from the break-even point, then the buyer will start making profit. Here also the short call, he also gain the premium received from the buyer up to the point of strike price, because the buyer will not exercise his right up to this point, and the profit will gradually fade out when it moves towards BEP. At this point the profit comes to nil, and when it crosses the BEP, then the loss will start it. So you should remember that the up to the point of strike price, it is very important that long call and short call, one is suffer loss and one is gaining the profit up to the premium, and BEP is equal to strike price plus premium paid in the long call. What I have said in the last class and today it is summarized here, you read it. In the case of long call, last para, the market is bullish, and as the profit related to the upward movement of the market price, and in short call the market is bearish. In put it is reverse. Long put, the same case, you should remember that the buyer of the put option will suffer a premium up to the point of the strike price, and if the spot price crosses this, the loss will be reduced up to the point BEP, and then started the profit. Similarly, short put, same case, he will gain premium up to the point of strike price, then profit will gradually comes down up. When it reaches the BEP, it will be nil, and when it moves downward, then the profit, he will suffer a loss. And BEP here, strike price minus premium. Here I also write the summary of the discussion, you read it. Next come option trading. Option spread, Option spread. The options involve combining option on the same underlining and of same type but different strikes and maturities. These are limited profit and limited loss position. They are categories into three sections. One is vertical spread, second is horizontal spread, third is diagonal spread. Vertical spread are used when market view of the investor is moderately bullish or bearish. The vertical spread implemented by buying and say or selling call or puts with different strike price but same expiry month. Vertical spread are classified as bull spread and bear spread. In bull spread, investor buys lower strike. You should remember this. This is very important. Buys lower strike and sell higher strike. And conversely, in bear spread, investor buys higher strike and sell lower strike. Horizontal spread. Calendar spread I have already discussed in future contract. Here it is not possible to draw the payoff chart as the expiries of the underlining are different. Now come diagonal spread, that involves combination of option having same underlining but different expiries but as well as different strikes. It is not possible to draw the payoffs. Summary of vertical spread. Market view moderately bullish for bull call, for bear call moderately bearish, for bull put moderately bullish, and bear put moderately bearish. Now strategy. Since it is bullish, so buy lower strike and sell higher strike, which is earlier it is mentioned. And in bull put, it is moderately bullish, so it will be same, that is buy lower strike and sell higher strike. And in bear call, that is bear call spread, it is moderately bearish, buy higher strike and sell lower strike. And in bear put, it is also bearish, buy higher strike and sell lower strike. Net premium. Because it is a combination of buy and sell, that will arise net premium, premium paid and premium received. And here net premium will be payable for bull call, receivable for bear call, receivable for bull put, and payable for bear put. Maximum risk. Net premium paid, difference in strike prices less net premium received in bear call. In bull put, the difference in strike prices, because there are two strike price, one is for buyer and other is for seller, and less net premium received. And bear put, net premium paid. Maximum reward, difference in strike price and less net premium paid for bull call, and for bear call it is net premium received, and bull put net premium received, and bear put difference in strike less net premium paid. Vertical spread, the assumption is given. Now spot price is 68.50. It is currency derivative. Now for call option, strike 1 is 68.5, which is ATM, which is equal to the spot price, and premium is 1.25 for call buyer, and 67.50 it is ITM, and it is 1.75. It is highest because it is in the money. And it is when it is 70, the strike price, it will be fall in the OTM position, and the premium call will be rupees 1. It is lowest. And for put option, 68.5 is ATM. The premium of put option will be 1.10. And when the in the call option, when it is ITM, then in put option it will be OTM. The premium will be lowest 0.90. And when in the call option it is OTM, then it will be ITM. For put option it will be 1.25. Vertical spread reduce the premium amount payable and also both risks and potential for return. Now come bull call spread. Bulls call spread buy one ATM call and strike price is 68.50. 68.50 and sell one OTM call at strike price is 70. So the strike price in buyer is lower than the seller, and premium payable is rupees 1.25 and premium receivable is rupees 1. So net cash outflow will be rupees 0.25, that is net premium payable. Net premium payable is the maximum loss. Maximum loss which occur when the spot price is on the lower strike price or even less than that. That is, maximum loss occur when the spot price is on the lower strike price or even less than that. And maximum profit will be higher strike price minus lower strike price minus net premium payable, that is 70, which is higher strike price, and 68.5 is lower strike price minus net premium paid is equal to rupees 1.25. This is the maximum profit which arises when the spot price is on the higher strike price and even higher than the strike price, that is 70. It will be same 1.25. And BEP is lower strike price plus net premium payable, that is 68.5 is lower strike price plus net premium 0.25 is equal to rupees 68.75. Now the calculation of the profit or loss is tabulated here. You see, long call strike price is 68.50 and premium paid is 1.25. Short call, it is higher than the buyer, that is 70, and premium received rupees 1 because it is OTM. Now since it is strike price is 68.5 up to 68.50, the buyer will suffer a loss of premium paid. And then if it crosses the strike price, that is 68.75, 0.25 will be the profit, that is 68.75 minus 68.50 minus premium, it is minus 1, and the short call he will gain 1, that is break even point is 68.75, which I have written here. Break even point is lower strike price plus net premium, that is 68.50 plus 0.25 is equal to 68.75. And when it crosses the 68.75, that is 70, then the buyer will earn rupees 1.25 less the premium paid is equal net profit will be 0.25. But for short call, the gain is 1 because the strike price is 70. Up to 70, he will gain the premium because it is his strike price, and total profit is 1.25. Now come 70.50. 2 minus 1.25 is equal to 0.75. Here profit will started to be reduced, that is 0.50. 70.50 minus 70, that is 0.50 is the profit. The resultant profit will be 1.25. Similarly, at the point of 71, the profit will be for the buyer 1.25, and here gain will be 0, and ultimate resultant profit will be 1.25. 71.50 profit for the buyer 1.75, and loss of the seller is 0.50. Resultant profit will be 1.25. And for 72, 2.25 is the profit for buyer, and loss is -1. It will be 1.25 the resultant profit. You come first. The for up to 68.50, the loss is 0.25. Resultant loss is 0.25 net premium paid. You see that up to the point of lower strike price, the loss is 0.25, and here you will calculate it up to the point the lower strike price, the loss is 0.25, and after that, after break-even point, it will be 1.25, and it is constant. 1.25 profit is constant. Next come bear call spread. Here buy the higher strike price and sell the lower strike price. You see, sell one ATM call 68.50, premium receivable 1.25, and buy OTM call strike price is 70, which is higher than the seller. Premium payable is rupees 1. So net cash inflow is 0.25. This is maximum profit of this strategy, bull call spread. You see, bull call spread, the profit net premium is the maximum profit of 0.25. It is written in the statement earlier, and it is just when up to the point of lower strike price 68.50, and when it crosses, the profit will comes down up to the break-even point. Break-even point is lower strike price plus net premium receivable, that is 68.50 plus 0.25, it will be 68.75, and after that the maximum loss is higher strike price minus lower strike price minus net premium received, that is 70 minus 68.50 minus 0.25 is equal to rupees 1.25. You see, the highest maximum loss will be 1.25, which start from the higher strike price 70, and if the spot price moves upward, then it will be same 1.25. Now to come to the table where it is calculated. You see short call. The strike price is 68.50 and premium is 1.25. So he will gain the profit up to this strike price 68.50. And here it is 70. Strike price is 70. Premium paid 1. So he will he will lose a premium up to the strike price 70, and resultant profit will be 0.25. You see net return is 0.25 up to 68.50, that is lower strike price. After that you will see 68.75 is the break even point. So here minus 0.25 plus 1.25 is equal to 1. Here it is minus 1. So break even point reaches. And after that the profit will start, that from the upper strike price. Upper strike price is 70. So you see here it will be minus 0.25, here it will be minus 1, the loss will be minus 1.25. Loss will start from upper strike price, and next you will see resultant loss will be 1.25. Whenever the spot price moves up, then the resultant loss will be the same, that is 1.25. Here bear call spread, and next come bull put spread. Bull put spread means sell is higher strike price, that is 68.50, premium is 1.10, and buy lower strike price, premium is 0.90, the net premium receivable is 0.20, that is maximum profit. This is the maximum profit which up to the higher strike price. When the spot price reaches the higher strike price, the up to that level the maximum profit will exist. And when it comes down to break-even point, it is nil. Break-even point is equal to, here you minutely remember that higher strike price, break-even point is higher strike price minus net premium receivable. Where in call option, lower strike price plus net premium, and here the put option, higher strike price minus net premium receivable, that is 68.50 minus 0.20 is equal to 68.30. So at 68.30 the profit or loss will be nil, that is break even point, and below that the maximum loss will be higher strike price minus lower strike price minus net premium receivable, that is 68.50 minus 67.50 minus 0.20 is equal to rupees 0.80. Here you see 0.80 is the maximum loss which starts from lower strike price 67.5, and if the spot price reduces, then also the losses will be remain same. So you come to the calculation in this table. Bull put spread, short 68.50 and premium is 1.10. You see up to the 68.7 up to the 68.50 the gain is same, that is strike up to the strike price the seller gain 1.10, that is premium received from the buyer. And in the long OTM put option, the strike price is 67.50 and premium is 0.90. So up to 67.50, the loss will be the same, 0.90, and break even point is 68.30. You see, you calculate it. When it is 68.30, the seller will lose minus 20, and premium paid received 1.10, net profit will be 0.90, and here the loss is 0.90, that is premium paid. So it will be resultant profit will be 0, that is break even point. And if the price moves downwards, then the profit will be reduced, 0.40. Here it is minus 0.90, it will be minus 0.50, and at 67.50, the resultant loss will be minus 0.80. You see that when the spot price reaches on the lower strike price, the maximum loss will start, 0.80. Here you see in the calculation 67.50, the profit of the seller is 0.10 and loss is 0.90 for long OTM put holder. So resultant profit will be, a loss will be 0.80, and like this you see the 0.80 will be the resultant loss in the case of spot, when spot is 66 or 67. Now come bear put spread. Here buy at 68.50, that is higher than selling strike price 67.50. The premium is 1.10 and here it is 0.90. The net premium payable is 0.20. Maximum loss will be 0.20. That is 0.20 is the maximum loss when the spot price arrived at the higher strike price. Then the maximum loss will start, and if the spot price moves upward, the loss will be the same, 0.20, and when the spot price moves downward, the loss will be reduced, gradually reduced, and becomes nil at the break-even point. And when it moves downward, it crosses the BP, then the profit will be start. Maximum profit will start when the spot price reaches the lower strike price 67.50, and it is 68.30 is the break-even point. Maximum profit, that is 0.80, will come out from the statement higher strike price minus lower strike price minus net premium payable. 68.50 minus 67.50 minus 0.20 is equal to rupees 0.80. BP is, always remember, higher strike price minus net premium payable, that is 68.30. In the call option, it is lower strike price plus net premium payable or receivable. Now this table shows the calculation. Long ATM put strike price is 68.50 and premium is 1.10, that is negative, and short OTM put is 67.50 and premium is 0.90. Now 68.50, up to the 68.50, the put buyer will suffer a loss of 1.10, and if comes down from the 68.50, the loss will gradually reduced, that is 68.30, the loss will be 0.90, and the short seller will gain the premium 0.90. It will be break even 0.00. Now the in the for the short OTM put option, that is the strike price is 67.50, so he will gain rupees 0.90 up to the point of his strike price 67.50. That is, now you calculate it 67.50, that is the buyer will loss minus 10 and the seller will make a profit 0.90, so the resultant profit will be 0.80. In this way you calculate the 0.80 will be the profit, and it will start from the lower strike price 67.5, and it will remain same when the spot price moves downward. Now come for the equity share. Vertical spread, I have taken the current market price is 16,500, and strike 1 for call option 16,500 is ATM, and the premium pay is 450, and 16,200 it is ITM because it is less than the spot price. The premium is highest, in this case 550, and 16,800 it is the spot price is higher, the strike price is higher than the spot price, so it is OTM position. The premium will be the lowest 350. In the case of put option, it is ATM, the premium is 350. What is ITM in the call option? Here for the put option it will be OTM, and strike price will be lowest 250. And what is OTM in the call option? The put option it will be ITM, and the premium paid will be highest 450. Now bull call spread, same case, I just given the problem in equity share form. Buy ITM call, that is strike price is 16,200, it is lower than seller strike price 16,800. The premium is 550 payable, and 350 is receivable, so net cash outflow will be rupees 200, that is net premium payable, which is the maximum loss. We start from the lower strike price, that is 16,200, and the spot price moves downward, it will be the same. And the break-even point, you know, that lower strike price plus net premium payable, that is 16,200 plus 200 is equal to 16,400. You see the break-even point is 16,400, and the maximum profit will be higher strike price minus lower strike price minus net premium payable, that is 16,800 minus 16,200 minus 200 is equal to 400. The 400 is the maximum profit, and it will start from the higher strike price and remain same if the spot price moves upward, and it will, the calculation is given in the next table. You see, for the long call, current strike price is 16,200. 16,200 is the strike price, and premium is 550, and short call 16,800 and premium is 350. So the up to the strike price 16,200 you will incur a loss of 550, and here up to the strike price 16,800 the premium is 350, he will gain. Here I spread the strike price because to show the how the profit or loss will be reduced up to the break even point. Now break even point is lower strike price plus net premium paid. Net premium paid is rupees 200. So break even point is 16,400. You see at the 16,400, you the profit for the buyer will be the 200 less premium paid minus 350 is the net loss plus 350 is the premium gain. It will be break even point. Now the highest maximum profit is 400. Maximum profit is 400, that will start from higher strike price, that is 16,800. Between this you see that how the profit increase gradually. Now 16,500, the profit will be 100. 16,600, the profit will be 200. 16,700, the profit will be 300, and 16,800, the maximum profit arrived 400, and it will continue as 400. The spot price increase move upwards. Next is bear call spread. Here sell one ATM call, strike price is 16,500, which is less than the buyer strike price 16,800. Here the net premium payable receivable is 100 rupees 100. So the profit will be maximum profit will be 100, which the spot up to the strike price 16, lower strike price 16,500, and if the spot price moves downward, the maximum profit will be the same, and the profit gradually reduces and comes down to zero at break even point. And after that the maximum profit is 200, that is my higher strike price minus lower strike price minus net premium receivable. Higher strike price is 16,800 and lower strike price is 16,500, that is 300, minus net cash flow is 100, that is 200 is the maximum loss. Maximum loss is 200, and which will start from the higher strike price 16,800, and if the spot price moves upward it will remain same. And the calculation is given in the bear call spread, you see, and you calculate here. Today I stop the class here. Next day I will continue it, that is put bear spread and put bull spread. I will discuss on the next day along with the straddle and strangle. Thank you.